Marcon, can you please describe a future?
So futures contracts they are essentially agreements between two parties that are linked through a clearinghouse. So one of the biggest clearinghouses is Chicago Mercantile Exchange. They will connect me with another person who wants to take the opposite position. So say I wanted to trade futures on the ASX. Well, I wanted to go long. It would connect me when I clicked that buy. It would connect me with someone who wanted to go short on the ASX.
Mm-hmm.
We would match up. I would be on one side, the other person would be on the other side. Say, at the end of the first day, the ASX has gone up 1%. Well, his account would go down, my account would go up, and they would even out. Basically, they would what's called as marking to market on a daily basis. They will settle all the positions they have open on a daily basis.
So you can buy futures long or short.
You can, yeah.
And you've always got an other side to the transaction somewhere in the world.
Yeah.
And do they have a fixed end date as well?
They do, but it's not as it's different options because you don't sort of they don't go to zero if they're out of the money. It's basically just trading what a future price will be. And what happens is, say you're trading the June futures for the ASX. Well, you could trade it all the way up to, the day before they expire in June, say June 15th they expire. You could trade it all the way up to the day before, and then what you would do is basically sell it, and then you would buy the next month if you wanted to keep your trading. You would roll over your position, so it's called, to the next month.
Okay.
To keep your position open.
Can you differentiate for me between just going long traditionally on the ASX 200 versus going long on a future for the ASX 200?
Okay. So futures are basically, most of the time they're the same thing. The only difference is being
are they a little bit higher risk, maybe?
A lot higher risk because they're traded on margin. If you've traded on margins, basically you have to have a set amount of money to keep your position open. You don't buy.
Oh, so it's leverage trading.
Yeah,
okay.
Yeah,
so that's why it's high risk.
CFDs before.
Yeah.
Yeah, it's exactly like that.
Okay.
Basically, what happens is they will say.
It's too intimidating for me.
Yeah, it's the problem with CFDs is the person on the other side of your trade is the fucking broker, and they have, the ability to move the market. Because CFDs are extremely leveraged, you don't actually need to move the market too much to blow a lot of people out. And because the brokers know where their limits are, where their thresholds are, whether they can push people out and clear them out, they don't have to move the market that much, and they can move it a little bit, push a whole bunch of their traders out. Whereas if you're trading against another person, like I could be trading against you, we could be trading on the CME.
So for the casual investor, they have to trade through a CFD. But if you're a large investment firm, you have significant enough money to trade the futures without leverage.
So you could trade, honestly. Well, I'm a retail trader, and I can trade. You don't need a lot of money to trade futures. You don't need a institutional amount of money to trade futures. It helps because you get lower costs and
nice
stuff.
Distinction of wealth. Yeah. Institutional. Yeah.
So you don't have to be. You can do it. And honestly, CFDs are a joke compared because, you have someone whose best interests on the other side it is to push you out of your position, whereas futures are...
Doesn't seem fair.
Yeah. So, back to your question, which was, what's the difference between buying the ASX versus buying futures on ASX, for example? Yeah.
Both long positions.
Yeah. So, the big difference is leverage.
Yeah.
Very big difference is leverage. Another big difference is margin. You're trading on margin. So you can get pushed out of your position and you could owe more than what you had.
Yep.
Another big difference is that if you do hold till expiration of the futures contract, because they are, when you buy a futures contract, it would be a date set. So I would buy the June 15th ASX futures contract. It would mean that the contract expires on June. If I didn't roll over my position, as in if I didn't jump to the later month, I would then have to settle the contract, which is a bit of a pain in the ass for someone who's trading and not.
Understood. So basically, The main difference is simply the amount of risk you're willing to take on, but fundamentally, your analysis is the same.
Yeah.
If you like, say, Combank, for example, and you know are really confident in your position, then maybe you want to take out a futures contract instead of a traditional long because the return is going to be higher through a future, but also the risk is higher.
You can't. I'm not sure, but I'm not certain on it. But I'm pretty sure you can't take out a futures on a specific stock. I think you can do it on indices, stock indices. You can do it on bonds, but specific stocks, no, I don't think you can.
Okay, interesting.
They're not liquid enough. They wouldn't have as active of a market.
Nice. Well, look, that's good.